because in my mind, we always, as long as you do the right thing for the clients, I mean, it's obviously you're selling at the same time, but I don't want it to feel like sell. We're going to talk about lines of credit. Lines of credit. I mean, some of you, Jorge asked me the other day, so what is the purpose? In what scenarios do you do a line of credit? You can do a line of credit by its own, what is called a standalone line of credit, or you can do a line of credit after the first. When you do that, it's called a piggyback. So piggyback is when you do a first and a second, and a standalone is when you just do a line of credit. Now, before we get into the guidelines and all of that, I'm going to show you. I'm going to show you something. Can you go to my email, or do I go to my email here? Okay. Yeah, Gmail. And can you pull the first one, bills? So I'm going to show you. Can you pull the Macy's first? So I'm going to show. Can you go down? So this is my bill from Macy's. Go more to the third page. Third page. That page. Now, my bill from Macy's. The main objection about lines of credit is the interest rate, and interest rates on line of credit right now is about 10%. This is my Macy's bill, and my Macy's bill, the interest rate, if you see it right here, is 30%. So I have a bill from Macy's that right now their interest rate is 30%. Now, the interest charge, and I already did the calculation just to see if it was right. The interest charge is only $15 because I only owe $500. So it doesn't feel that bad, but in reality, it's 15%. It's 30%, I'm sorry. So 30% is a lot percent. Can you pull the Barclays bill? The Barclays, it has something very interesting. Before we go into the interest rate, another objection when you're refinancing right now, what is one objection that when you refinance, Pulido, do you know?
Well, besides the high interest rate? Pretty much it.
Or you're going to lose the interest rate that you have on the first.
You're going to lose the interest rate that you have on the first. Another objection is, if I do a mortgage, it's going to be for 30 years. Oh, no, because it's for 30 years. That's a very common objection. Let me show you my bill. In this one, I owe about $8,000. I'm not going to show you what I charge. But it says if you do only the minimum payment, you're going to last 23 years to pay this credit card. 23 years to pay this credit card. So I run into a client that he wanted to help his son, but for whatever reason, he was not giving me his information. His son didn't qualify by his own, but he was already set on, I don't qualify, I have too much debt. The guy had $100,000 in debt. $100,000 in debt, and he was paying $3,000. So he was paying $3,000, and I said, hey, you know what? The necessity changed from helping your son buying a house to refinancing you. We need to refinance you. And if I refinance and I pay all your debt, you're going to pay $1,000 extra. Maybe your interest rate is going to be higher, but in reality, you're paying $3,000. And the first reaction of the client was, yeah, but a mortgage is for 30 years. A mortgage is for 30 years. The problem that clients are not seeing, and probably loan officers are not seeing, is the credit cards also are forever. They are forever. I mean, if I pay the minimum, it's only 23 years. And I'm going to pay an interest $24,000. At the end, I'm going to pay $24,000 on a debt that I own for $8,000. And in reality, I think, but in reality, it's based on the $5,000. It's not even based on the $8,000. So when you talk to clients, make sure that you understand their debt, and that you understand the situation that they are in, so we can help them better. Jorge, I always tell this story that when I started in this business, I gave interest rates. And Jorge was giving higher interest rates than the ones that I was given. And the clients were rejecting my estimated, and they were accepting Jorge because Jorge has the voice of a kid. And we always joke about Jorge that he has that voice when we were kids and everything. I mean, he always talks to you like, and then here comes Oscar. Here it is. And I say, Jorge, what's the secret? What's the secret? And he told me the secret is because you're giving the interest rates and you're afraid. And when you're afraid giving the interest rates, clients feel that. So the interest rate is the interest rate. But when you give an interest rate that you're afraid, clients feel that and they reject it. The same thing happens to me. I'm going to be honest because I never lost the scaredness, but it happens to me on lines of credit. When a client comes to me and he says, hey, I want a line of credit. I go like, a line of credit at 10%. What am I going to do? How am I going to sell it? But the same thing happened to me when I was at 3% and I needed to sell an interest rate at 3.25. How am I going to sell 3.25? Well, right now it's at 7. Right now it's at 7. And if I understand the depth of the client, why should I be scared? Why should I be scared? I mean, yeah, the interest rate on a line of credit is 10%, but dude, you have 30%. If we go down, Dawson, you're going to see on this one, I have about 25% interest rate also. Continue. Don't show my charges. Hold on. I think it's on page 4. The previous one. The last one, the number 5. Go to number 5. Interest rate 25%. 25%, which is the same thing. Good thing that you left, Jorge, because we talked bad about you. So understand that. Understand that the client is in debt. The client is with a very, very high interest rate. Does it make sense to change it to a lower interest rate? Does it make change whether he wants to refinance? Whether he wants to refinance just the first, does it make sense for him to refinance? If he owes $100,000, I mean, obviously he is going to make a lot of sense. It's going to make a lot of sense. Now, if the client says, well, no, because it's another 30 years or anything, and this I can pay in 10 years or something like that. Do you want to live miserable for 10 years? Or do you want to live comfortably for the next 30 years? So that's the difference. That's the main difference. So let's talk about lines of credits. Can you pull the other email, Dawson? And let's go ahead and pull the attachments. That one. So lines of credits. Let's understand lines of credits. They don't offer lines of credit for investment properties. We just got another investor with Deep Haven that we're going to talk. Pulido's going to talk a little bit about Deep Haven. That it has a line of credit, but as far as Symmetry, which is the investor that we're losing, they don't do investment properties for lines of credit. They do they do lines of credit for first owner-occupied properties, second homes, and the standalone. So there's a difference between a piggyback and a standalone. I already said the difference between a piggyback is when you purchase a property and you do a first and a second. What is the scenario that we're using a lot here on a first and a second? This scenario, I'm using it a lot for Riverside and those county, Riverside and San Bernardino. Riverside and San Bernardino, the conforming loan amount, I believe, is 726. So it's around that number, the San Bernardino County. Now, if a client is buying a $1 million property and he wants to put 10%, if he puts 10%, that's $100,000. So he ends up at a loan amount of $900,000. If you want to do that loan, it is a jumbo loan in those counties, unless you do a first and a second. So what we're doing a lot in those counties is that we do a first at 726 and the second for the rest of the money. And that's a piggyback. We're using it a lot. The good thing about Symmetry is that allows your LP also, which is something that is great. That, for example, they're asking you a ratio of 45%, but if the LP is with 1 year of taxes, they'll take that 1 year of taxes. You don't need to qualify with 2 years. So if you have a self-employed borrower that you're doing 1 year of taxes, Symmetry takes that as long as they're under 45%. The guidelines, I believe most of you have them. You can do a piggyback also. The rate gets affected. The rate gets affected when you do a first and a second. It's not the same rate for doing just a first. But if you do a first and a second, then the rate gets affected. It's higher interest rate for the first. Now, if you fall into that situation that you cannot sell the first and a second at that, if the client is available to do it, what Symmetry has is that they say you can close the first with a down payment, and soon after you close the first, if you do it within the first 90 days, you can do a second within the first 120 days. You can do a second as a piggyback. So let's just pretend that the client puts 30% down payment. 30% down payment, you close the first, and then if you do the second within 120 days, then they will consider it as a piggyback. They will take the appraisal, they will take the title, they will take everything that you did on the first. But on the first, you just did it as a first. And do not a standalone, a piggyback within 120 days. You can do a piggyback within 120 days. Does it make sense? Questions about that?
Yeah. Not only that, but it gets cheaper for doing both. With the first investor, you don't get a hit for secondary financing, and with this one, I don't know if you can scroll down just a little bit, Dawson, please, right there. As you can see, the hits right there, which says standalone HELOCs is a lot more than a piggyback HELOC. So two things. When you do a first and a second, if you close them, the interest rate on the first, it gets affected. The interest of the first, it gets accepted. Now, a first and a second, a piggyback has better interest rate than a standalone second. Now, what Symmetry tells you is like, hey, if the first is getting affected by the interest rate, you can do a first, close the first, and then do a second, but we're not going to call it standalone. If you do it within the first 120 days, we're going to call it a piggyback, and you get the rates for the piggyback. And you can get your money back. As long as you can go up to 90%. Up to 90%. Make sense? The only thing that I see, and I always try to be very honest with you guys, the only thing that I see that is a drawback with our lines of credits, with the lines of credits in the market, is that right now, the big banks, I don't think that they're offering lines of credits. If you want to do a line of credit, the ones that are better is the credit unions. Now, the credit unions, just so you will know, they're offering an introductory rate. Now, the way that they sell this lines of credit is like the painkillers. It's like the painkillers. If I sell this line of credit, I'm going to sell it, and I can quote it right now, and it's going to be higher than 10%, or it's going to be 10%. But what the credit unions are doing is that they're offering an interest rate of about 5%. But it's an introductory rate for 3 months. After 3 months, what they say is the rate that is in the market. What is going to be the rate? Well, the rate that is going to be in the market. But what is going to be the rate? The rate that is going to be in the market. And they never mention 10%. If they never mention 10%, obviously the client says, all the credit unions. So that is the drawbacks with the credit unions right now. I'm not saying that they're bad or anything. It's just that they don't offer they don't say what is the actual interest rate. With lines of credit, I don't know if you know this, but usually the first 10 years is interest only. And the first 10 years is like a credit card. You can use the balance and you can return it, then you can use it again, return it. Now, for those 10 years, you can do it back and forward. After those 10 years, you have to pay the loan in the other 15 years. Most lines of credits are that way. Most lines of credit are that way. In the second period of 15 years, you cannot draw money anymore, and you have to pay the loan in full in 15 years. Any questions? Okay, so I'm going to leave with Pulido. Pulido is going to show you a little bit about the system. How do you basically structure the lines of credits in the system? Because every now and then we get a phone call. We get a phone call from you guys that is at the worst hour, and it says, hey, how to put the system in the, how do I put the line of credit in the system? I mean, Gonzalo called me at 12:30. Everybody knows that I go to lunch at 12:30. So Gonzalo called me at 12:30. I'm doing a line of credit. How do I enter it in the system? How do I enter in the system? So Pulido is going to show us how. And Gonzalo was also driving. I don't know why he called me at 12:30 if he was driving and not in a computer. So
you can do it. All right. Let's see. Okay. Bear with me a minute. Oh, he didn't tell you this. We need to sign into. Oh, can I do it here to LendingQB?
yeah, you can do it there.
I could do it here. Okay.
With my user and password, just hit the LendingQB.
Okay.
Hold on. It is 7511.
So where are we? I'm blind here. Go into you have access to all the company's lines. Okay, which one is that? Which tab? Loan officer pipeline number 2.
That's in the process.
One more
Last one.
right there. And then let's open up in the approved loan. Let's open up what's ¿Dónde está? I don't see it. Help me out, Dulce. Are you there? We're gonna use your loan.
Good morning. Yes, I'm here, but I don't see it.
You don't see it. No, it's not in the approved.
Arellano.
Okay.
The second one.
Oh, there you go. No, but that's a different Arellano. Isn't it? Well, it could be that. Jorge, is it Jorge Arellano?
Yes.
Okay. Yeah, I don't know why your name's not there. You've been erased as the loan officer. Sorry. Because you're not here.
Wow.
Okay. So that one, go into where it says files on the left side. On the little square on the bottom. Or I have control of that too. Oh, let's see. Does the mouse? No, espérate. Okay. No veo el mouse. Oh, there it is. Okay. There it is.
Is the loan application.
No.
Okay, right there,
Aquí.
on the bottom.
No, pero. No, sandbox file. Aquí. Okay. Okay, so on this one, I'm gonna erase everything and start again. Leave for now. Okay, so let's assume this is just a regular purchase right here. And okay, a regular purchase. What she wanted to do with this one is and it's the same process whether you add a down payment assistance or in this or a HELOC, it's the same process. Okay, in this case, she is using a down payment assistance from the LIPA program from the city. Okay, and she wants to use the full 140,000. Okay, that LIPA offers, and this is on a condo. So as you could notice on the top, when you first, this is the correct sales price and everything. Now, what she wanted to do is, I'm sorry, right here. Initially, she said she wanted to use the whole 140,000. Okay, so this is what it looked like. Okay. As you could see up here, the LTV is 63% and combined LTV is 63%. So that right there tells you that it's we need some work to do. So it's not just only putting, well, my down payment assistance from the city, I'm going to use it. Well, here it is. Here's 140,000. Well, Meridian is not calculating it properly. What you need to do is tell the system that you have a first and a second. Okay. Are we clear so far? Pretty basic. Okay. So this is where we need to tell the system that we have additional financing in addition to this right here. This loan amount of 240,000, that's going to be your first. This amount right here, right now, represents 63% of your appraised value or purchase price, which is the same here. Okay, so that's why you're at 63% LTV, because that's what the 240 represents. So now you want to tell the system that we want to use, we're also financing, even though it's a silent second and no payments, but you still got to go to this, either go through this hyperlink right here, the other financing, or the, you know, you could have it right here. I don't know if he has it on his favorites where it says other financing, but anyway, in either case, let's go right here to the other financing page. She described what she wanted to do, and right here is where we would put the amount. This is the 140,000 that we want to use. Okay, since this is a silent second, there is no other term. There is no interest rate, and there is no term. If this is a second loan with a symmetry or something, this is where you would put the rate and the terms. Okay, but since there is no payment on this one, so all you have is just the loan balance. You're gonna have a second for 140,000. When you save, it's not gonna change your DTI any, because you didn't add anything. It's a silent second. But what it did do, if you notice, the combined LTV went up to 100% now, which means that if you submit the loan like this, you're telling the system that you're going to have a first loan of 240 and a second loan of 140. Combined, that's going to be 100%. Now, but then she said, but no, well, I don't want to use the full 140,000 for the down payment. I want to use for down payment and closing costs. Okay, so then, first of all, let's see if you all are with me. Any ideas of to how we would adjust that here from anyone? No. Okay. Yes, sir.
Most of the loan officers and most of the people are not gonna do this type of program. Would it be possible if we can do just a standalone second, someone that says, hey, I don't want to refinance, I have a property, the property value is 900, I owe 500, and I need to take 100,000 out.
Right.
As a standalone second. After this one can.
Oh, of course. Yeah, that part I actually thought it was going to be a lot easier. It would take me like 5 minutes, but so we got time. So then, but yeah, that was definitely on my list, the standalone second, because that's always very popular. So anyway, to adjust that here, and it gets confusing, but where you would adjust it here is on your loan amount. Okay. Besides, the city says that, you know what, I'm going to give you 140,000, but out of this 140,000, you need at least 1% of a down payment from your money. Well, how do we differentiate that here? I'm already getting 140,000 here total. So no, this is where you would adjust it. And I hope I don't lose you guys here. So as it stands, let me see, do we have Do you have details of transaction on your, do we see it here anywhere? No details of transaction, okay, no. Espérate. Okay. As it stands right here, the way we have it structured, according to this, the client is gonna need $10,000 to close. The way that we have this is your purchase price, you have your subordinate financing, your 140,000. He already gave 5,000 as a deposit, but after your closing costs and you know that you have a balance of 10,000. But this is not exactly what so this within this money, this is enough for his 1%. This would cover his 1%. Okay, so we can leave it like that, and the borrower would need 10,000, but he doesn't need 10,000. He's gonna need less than this. You could actually increase your loan amount. Okay. And you see your LTV, even though it goes up to 102%, is that allowed? Would that pass my DU? No. Okay. For the most part, no. You're right, and I'm not gonna spend too much time on this, but actually, it can. Okay, under one program, under the Home Ready program. So under the Home Ready program, you could go up to 105% LTV. Combined. Okay, that's the only one. Otherwise, it's gonna be a minimum of a maximum combined LTV of 97%. So remember, this you're not gonna touch. If you know you're getting 140 from the city, then that goes right here. That's 140,000. That doesn't get touched. But now, what if you want to adjust now based on what we just did? We just increased it 10,000. We increased our loan amount 10,000, and now the client only would need $875 to close, taking into account that he already has put in $5,000 of EMD. Okay, so you could actually increase it a little more, but up to the point where you don't go below $3,800, or is it 380? Yeah, because 380, 1% of 380 is 3,800. So as long as the borrower brings in $3,800 here, then you're good. Okay. Any questions on that? You know what? I added to your favorites, by the way, because I like this screen. Now let's do. If there's no questions of that, I'll go to just doing a straight standalone second. Okay. No questions? A new loan. Okay. So
just do this loan info on the new one.
is still okay. So you want to close this one and open up a new lead?
Yeah.
Okay.
I just do this loan.
A ver. Espérate, cerrar aquí.
Before you do that, So what Polino was showing you, I mean,
All right.
Polino, sometimes he gets on drugs and he starts talking about other things. Stop
right.
using the medicine that I told you, Polino. So basically, this loan info. So this loan info, this is for the first loan. But for the first loan, where do I enter the HELOC? So the bottom line, where do I enter the HELOC? On other financing. You can see it on other financing on this screen, or you can see it on your list of options. There's another option that is other financing info. If you go to that other financial info, this is just the first. So on the first, the client is buying for 380 and the loan amount is 250.
250, the system thinks that you're doing a 65% LTV. So at that point, the system thinks that you're doing 65 LTV. Now, if I'm going to do a second that is a piggyback, I go to other financing, and other financing on this specific case, that Dulce has is a loan that it doesn't require a payment. But you do mark that it does require a payment. You say additional financing. This is a new loan. This is a line of credit, and this is the interest rate on my line of credit. And how much is the line of credit? The line of credit, it could be for 100, for 120, for X amount. What Pulido was trying to show you also is make sure that you confirm your CLTV, because the CLTV cannot be higher than 90%. In reality, it cannot be higher than 89.99%. So as long as if you're doing a line of credit and the CLTV is under 89.99, you're going to be fine. If you're not, if you're at 90% exactly, then it's not going to let you register the loan. It's not going to let you register the loan. So be very careful. You go here, you put the amount, the interest rate. The interest rate is on the line of credit, and you have to be qualified. You have to be qualified at 2% higher than the interest rate. So I always put the interest rate at 2% higher, so I can check if my ratios are under 45%. So that is the bottom line. Or how do you do a first and a second? You go to other financing, you put it here. When you go to register, the system knows that you're doing a first and a second, and it's going to allow you to register the first and a second. Clear? Okay, show us the second, just please.
Yeah.
But a line of credit, please, don't go rogue on me.
I'll explain everything. Everything will be clear as mud by the time we're done. So, okay, so close this one. And
Julio, por favor.
¿Qué pasó?
La pinche line of credit.
I can't read over here. Where's your new loans? A ver, no. Aquí? No, refinance lead. There you go. Okay. ¿Quieres darme un escenario, Jorge?
Okay, so property value.
Okay.
800.
Espérame. This loan info. It's because I don't know why he has this landing page.
So appraised value.
Appraised value,
800.
800.
The loan amount, 150,000, the line of credit.
The line of, so we want to credit. So this is going to be cash out.
Yes.
It's going to be a second mortgage, conventional. So far, so this is important right here. Cash out, second mortgage. Appraised value, 800,000. And he wants to take out a HELOC for 150. Okay. So far, so good. So save. You're gonna say to yourself, what is that it? Is that how easy it is? No way. No freaking way. But yeah. So far, as you can see, with that information, that we could see that line of credit represents 18% of the LTV of the 800,000. So now I'm sure there's a first. And where would we put the first? The first goes exactly right here, where it's just reversed. Okay, right here.
He owes 500.
Okay, so right here is where you put, and right here, yeah, as you can see, this thing changes. Additional financing is a new loan, or which is it?
No, it's not a new loan.
No, it's not a new loan. So it's just uncheck that. So it's an existing loan. So no, so he's not doing a piggyback. Only second. So right here, let's say originally, yeah. No, this is for the first. Well, what's the balance you said? 500. Okay, right here, current balance 500. Regardless of whether, let's say it was 600 initially, it doesn't matter. It's going to calculate it based off of this right here. So, and you take your PITI from down right here, 2,800. There you go, and save. And as you could see, now your combined loan to value is 81%. Now let's see, Symmetry will do one because they go up to 89.9, so you're good with Symmetry. Okay, so you'd be good right here. So you could actually increase it up to 89 if you want, but
Restriction of finance.
yeah,
It's on the.
which-
matrix.
yeah, it would be on the matrix.
Okay.
Yeah, I don't know off the top of my head, but basically that's it. Now, when you do this, as you can see, your payment here, this is your total payment for both first and the second. It does not break down taxes and insurance because that's already included on your other financing right here.
Pulido.
Gonzalo.
Una pregunta. En tu equity line no le has puesto rate. ¿Te va a modificar algo cuando le pongas el rate?
Of course, that would, and we don't have income, and that would be your DTI. That's why there's no DTI here yet. But yeah, so far we know what their monthly payment is. We have no idea whether they're going to qualify or not. But at least we know that from the first and the second, we are within the guidelines as far as combined loan to value.
No, but how do you get your equity line payment if you don't have rate?
What he's
Come on.
saying is the 416 is at 0% interest rate, correct?
The
It's being calculated at 0% interest.
416, no, the 150 you mean?
Yes.
No, there's a payment of 416 already.
Oh, that's just principle. If you take this, that's what it's doing right now. It's taking, that's it. But yeah, that would change definitely. See, so now when you add an interest rate.
Now
So
we are talking, Pulido. Now we are talking.
you want to, okay. So then, well, but the rest of the stuff you guys know, that you would input the income to get the DTI. But to know your payment, I mean, this is, you could work it all right here in this screen. Did I miss anything?
It's calculated until you go to the pricing, and that's your interest rate, and that's where you're gonna have your payment, correct?
Well, no, your payment is here. Once you input your income, then your DTI is calculated.
No, the payment of the first, we don't know, you just put 10%, but we don't know what the rate
No.
would be. correct?
Oh, no, you're right. I just put 10%. Yeah, but we haven't checked pricing on it, right? Well,
See,
and if you're doing the HELOC with Symmetry, you don't go through Meridian pricing to check it here. That's very important. You don't go into run price my loan because you're not going to get your pricing there. So this interest rate, you would get it directly from the matrix. Do we still have it up? Dawson, the one, the PDF, the one that from Symmetry?
Yes.
Was it from, yeah. The only reason why you would go to Meridian is to run price my loan is to register the loan. But here is where you would get your pricing for your HELOC. Okay, and based on this, I don't know if you could do a quick review. As you can see at the top right here, this is your prime rate, your bear rate without any hits. So you're starting out with 8.5% right now, as I think this is current as of July 28th. So 8.5, and then you do your add-ons. Like I said, to that, depending on the FICO score, and if it's a standalone, so on top of that 8.5, this is what you would add, depending on their FICO. Okay, and also depending on the amount. Any questions on that? Assuming we're doing a standalone, because this is after 120 days. So this is a standalone HELOC, so you get your 8.5 rate. So far we're at 11.5 based on this. 11.5 plus, I don't know if you got between 100 and 149, that's another quarter hit. So 11.5. So you're going to have a rate of 11 3/4.
So if I'm
Okay.
at 150, that's minus 0.25.
If you're doing a piggyback.
If you're doing a piggyback, you're right here.
But
Right
so
here.
the standalone, there's
Yeah.
no hit.
And no, I mean, there's no credit. This is actually a credit back if
Yeah,
you're
but
doing a
that's on the
piggyback. Yeah, on a
The
piggyback.
standalone, on that case, I don't have any hits.
Yeah, anything amount, yeah, it's just, well, it's just 8.5 plus your 3 right here.
So
That would be a rate.
That's how you put it manually on the system. You
Then
don't program the
actually,
system, you put it manually.
what you would do, since you ask if we're working with symmetry, because look, it says right here, to qualify, you need to qualify, the DTI has to be within these guidelines here, 45%, but what you use to qualify is your start rate plus 2%, amortized over 30 years. So in this case, let's see, can we go back to lending QB? Oh, I had it open. I just had to, okay. There you go, right there. Right there. Yeah, it's there. Okay, so right here, we will need to change this rate. Remember that the actual starting rate is going to be, well, you know what? This is a standalone. Yeah, we would actually do it here. So 10, that would actually be 12.5 right here. And it does say amortized over 30 years. So we have this right. Okay, so the client's going to qualify based on this rate, and this, even though this is not going to be his payment. It says $1,600 if it was 150,000 at 12.5%. No, 13.5. No, I'm doing okay, but you get the point. It's actually, yeah, you're right. It was 13.5, but whatever. But in reality, his payment is going to be. Actually, this won't even calculate because it does interest only. Yeah. Or can it do it in interest only right here? For
You can.
oh,
You can do it on this EMI.
or you could do it with your calculator. 150,000 times 11.5%, 17,250 divided by 12. Your payment's actually 1437. So you don't need the system to do. You could do it manually in 20 seconds. Okay.
So
So-
the confusing part here,
Oh,
it's multiple subjects, guys. The payment actually is interest only. So the payment is interest only. But the payment of interest only is not used to calculate the ratios. So one is the actual interest rate. The actual interest rate, let's just pretend that it's 10.5. But in order to qualify, you need to qualify fully amortized at 2% more to qualify. So you need to qualify at 12.5, fully amortized. But in reality, well, Pulido says, well, to qualify is 12.5, and 12.5 interest only, that is the payment in order to qualify. But the payment actually is at 10.5 and it's interest only, and it's interest only for the first 10 years. So don't get confused with that.
Well, that example was 8.5 plus 3 points, so it was 11.5.
11.5 now.
13.5 to qualify.
13.5 to qualify. That is correct. One thing very important, give me 1 second. One thing very important is how is my interest rate going to change? How is my interest rate going to change? How would you answer that, Gonzalo?
Say it again, please. Your interest rate is going to.
If the client says, so how is my interest rate going to change?
Up to the market.
Up to the market. Okay. So that is just just an answer just out of a hat. In reality, the interest rate is going to change. Right now, the prime rate is at 8.5. Right now, the prime rate is at 8.5. Now, I'm going to show you the history of the prime rate right now. Which the prime rate right now in the last, I believe the last 20 years, this is as high as has it been. Now, the bank wants to make a margin. So basically what the bank is telling you is, I'm going to charge you the prime rate plus a percentage that I want to make. The percentage that I want to make, I'm always going to make this hit. If you're doing a piggyback or if you're doing a standalone,
I'm gonna add 2%. 2% is what I'm always going to make. Or if I'm doing 1.5 and plus 5, I'm gonna make 1.75. That's what I'm always doing. So the prime rate plus that, the prime rate plus that. So that is how your rate is going to change. Now the prime rate, if you go here, so the prime rate is the WSG, and the prime rate right now is at 8.5, like they show you. Is there any questions? In the history, the history is this one. So it started in 2020 at 3.25. Right now it's at 8.5.
Las agarré del Tesla. Ahí le dejé dos al gordo.
Juan, mute. So that is the history of the prime rate. If it continues to go up, whatever the prime rate plus the 2%, that's going to be your interest rate. Will it continue to go up? Will it continue to go up? It probably will during the next 2 years, but it will go down eventually. The history is been very low. So your interest rate can drop at, if it's at 5.5, you add 2 or 175, and that's your interest rate. That's how it's going to change. That's how you explain a borrower, how it's going to change. Questions?
How do you make your commission, Oscar?
The commission, if you do a piggyback, you can only charge $1,000. If you do a piggyback, if you do if you do a standalone, I believe you only can do $1,000. Now, if you do a piggyback, you can do $500 on the second. $500 on the second. Now, lines of credit is about getting the client. It's about getting the client, helping the client. So it's not about selling here. It's about getting the client, and eventually, if you have a first and a second with a line of credit, eventually you will refinance when the rates go down. So it's about service. It's about helping the client. Now it helps you a lot. Right now, I have another client that wants to buy a second property. He qualifies for 500,000, and he wants to buy in those cities that are in the middle between Palmdale and Santa Clarita. And he says, my dream house is at 550. He says, you don't qualify for 550, you qualify for 500 with your debt. But if you put down payment, and if we pay off your debt, then you qualify. So let's do a line of credit. Because you live in this house, you want to buy another one, 550. What do we do a line of credit here? We get money for the down payment, we eliminate your debt, and guess what? Phil is not going to question, well, you just refinance owner-occupied, you cannot buy owner-occupied. Why? Because he never refinanced owner-occupied. He just pulled a line of credit. And the line of credit and the first mortgage, I'm going to eliminate it with the rent. So the first mortgage with the line of credit, I eliminate with the rent. I use the line of credit for a down payment, and I use the line of credit to eliminate all his debt. Does it make sense? Am I making money on the line of credit? No, but I'm helping him buy another property. Agent and client very happy. Make sense? Makes a lot of sense. You don't have money. There's a lot of clients right now, a lot of clients who own a house. I believe Gonzalo also. Gonzalo has been toying with this idea that if you own a house, it's a great investment. It is a great investment. I don't give a flying freaking shit about the interest rate. It's a great investment. Why? Because Gonzalo, how much your property is worth right now?
More than 700.
More than what?
700.
700. How much you owe on the property?
320.
How much?
320.
320. So 320, more than 700. Was it a great investment? Gonzalo, I mean, not that I'm talking too much personal information, but Gonzalo, years ago, in the 2008, 2000, and those ones, he was at dire straits with that property. That he didn't know whether to sell it or to keep it. Was it a great investment to keep it? Yes. how much do you own your property, Maria? Like 200, how much is it worth? Like 750. So clients right now are going like, it's a great investment. I don't give a rat ass about the interest rate. I want to buy another one. I want to buy another one. But the shock when they want to buy another one is that it's not as easy as to qualify with the first one. Now it's a little bit more complicated because the interest rates are higher. Maria, get a line of credit, use it $200,000, use it as down payment. Boom. The rent on the first, I'm going to eliminate it. I'm going to eliminate it the first and the second with a line with the rent, and you're going to buy with a down payment of $200,000. Makes sense? Is that your dream of buying another second house? Yes. The clients that want to do that. It's not your dream, Maria. But Maria just mentioned that's the idea of Alex. That's the idea of Alex. So guys, there's a lot of clients. There's a lot of clients who own properties. They want to buy a second home. They want to buy a second home because they already saw that it's a great investment. So those clients, hey, we need to do this. You don't qualify, but if you do this, you qualify.
That's for the standalone 2 years taxes. There's no 1 year. There's no 1 year LP.
No, there's 2 years of taxes. 2 years of tax on a standalone.
Just to ask a question, I don't answer. On the HELOCs, they cannot put cosigners depending on the property to help with the income, right?
That I don't know 100%. Maria is asking about co-signers on the HELOC. I don't know. If they live in the property, I think they could. HELOCs are very flexible. And also, right now, to do a cash out, you need to be on title for a whole year. I believe in the past, HELOCs didn't care. So it's a question that if you cannot do a cash out with a refinance, can you do it through a HELOC? Because HELOC in the past, as long as you were on title, you were able to refinance.
HELOCs in the past was stated.
Other questions, guys, before we finish? Okay.
Oscar, the question that Maria did was a good question. So can you ask if, like, for example, the kids or family members of the person who have living in the house can help to qualify for the HELOC? Probably is allowed.
Do you guys get this email or not? This email, it comes from a guy that his name I missed the name, but he's a great guy. He answers your email within a half an hour. No more than a half an hour, you're gonna last with the guy answering your email. So any questions that you have that is not on this guidelines, because it talks about trade lines, it talks about acreage restriction, it talks about a lot of things with the guidelines that you need to review. But any guideline that is not here, just send it to the guy. He responds within 15 minutes. He will respond you. He's a great guy. So as far as co-borrowers, non-occupant co-borrowers, all of that. So it's actually saying non-occupant co-borrowers allow with the 720 on the primary wage earner. On a standalone, it's not allowed. Only on a piggyback.
So does it mean that if they give the property or the standalone, they will be allowed?
Say that again.
So on the standalone, the co-borrower.
This is a non-occupant co-borrower. Non-occupant co-borrower is somebody that doesn't live in the house, and it's very obvious that doesn't live in the house. Non-occupant co-borrower is a guy that in the pay stubs, on the bank statements, on everything, it shows another address. Now,
so if they do live in the house, it is allowed.
It is allowed. It is allowed, but a non-occupant co-borrower is not. Now, this was very common in the past. In the past, it was very common. It says allow with 720 for the primary wage earner. So the primary wage earner, who's the primary wage earner? The guy who makes more money. The guy who makes more money. So the guy who makes more money, 720. That's the guy that they're looking for. Okay. Minimum draw. This is a huge deal. A huge deal. Before we finish, minimum draw is $50,000 on this one. What does it mean? Minimum draw $50,000. that when you do the line of credit, you have to pull $50,000. Now you can do a line of credit, a standalone line of credit of 150, but you have to pull $50,000. Now you can return those $50,000. You can return it if you want to. And then you don't owe anything on the line of credit. But when you close the transaction, you have to pull $50,000. We were involved in a transaction. I don't know if Ademar is here or not, where the client, we were going to pull, originally the client said $100,000. Then the client changed their mind and changed it to $50,000. When they changed it to $50,000, we made a mistake, not us. We informed the bank and everything, and they pulled $100,000. The client was very upset because he was paying interest on $100,000. Return it. Yeah, but I already pay interest for the whole month. So we have to compensate that client with the interest of that month. Make sure that you're aware of that. Any more questions? No? That's it. Thank you.
Thank you, Jefe.
Right. ¿Usted me saca?
Thank you.
Hans? No, Dustin?
Yeah.
Thank you.
Thank you.